Hey everyone, welcome back to The Explainer. Now, think about the early days of the internet for a second. It wasn't born with Facebook or Google, right? But it was really only when those massive platforms exploded that the average person actually started using the web. Well, Bitcoin is exactly like that for the crypto world. It wasn't technically the first digital currency, not by a long shot, but it is absolutely the one that made blockchain a global phenomenon. So today, our goal is to objectively dissect this dual nature of Bitcoin. We're going to strip away all the wild hype and really compare its theoretical promises as a revolutionary technology against its practical everyday financial realities.
Okay, let's dive into this. Here is our roadmap for today. First, we'll look at the origins of decentralization. Then we'll hit the speed compromise, followed by technical versus economic power. After that, we'll examine the whole digital gold and volatility narrative, and finally, wrap up with the traditional portfolio.
All right, part 1. Origins of decentralization. So before we get completely lost in the complex economics of it all, we really have to ask a foundational question. Why does decentralization actually matter in the crypto space? Well, building on primitive 1990s precursors like Hashcash, the real catalyst was actually the year 2008. The global financial crisis fundamentally shook the world's trust in traditional banking systems. Millions of people watched their savings just evaporate and naturally started doubting the institutions that were supposed to protect them. Right in the immediate aftermath of that massive crash, the anonymous Bitcoin white paper was published, and its central, brilliant idea was to completely remove the middlemen, the banks who were at the dead center of the crisis, and replace them with a distributed network of independent nodes.
Now, in theory, that decentralized idea is absolutely perfect. In centralized systems, authorities like central banks or governments completely control the rules and the money supply. But in a decentralized system like Bitcoin, power is distributed across thousands of independent nodes. No single entity can just wake up and decide to print more Bitcoin, freeze your account, or block a transaction. And it's incredibly secure too. To actually compromise this network, a bad actor wouldn't just hack one central server, they would literally need to control 51% of the entire global computing power of the network. While that's not strictly impossible according to the laws of physics, in practice, it is incredibly difficult to execute.
Moving on to part 2, the speed compromise.
And this brilliantly illustrates the real bottleneck here, because as beautiful as that decentralized perfection sounds on paper, it comes with a seriously heavy practical cost, and that is speed. Bitcoin processes an average of about 7 transactions per second globally. Meanwhile, Visa, which is a highly traditional centralized network, processes around 5,000. The technical limitation is just immediately obvious, right? Decentralization inherently creates severe latency because thousands of nodes around the world have to agree on every single transaction, which just dramatically slows down the entire system. To try and solve this severe latency issue, developers proposed a bridge, and it's called the Lightning Network. It basically works in 3 simple steps. Step 1, 2 users open up a channel with one single slow transaction on the main blockchain. Step 2, they move off-chain, where they can instantly exchange massive amounts of payments with virtually no fees. And finally, Step 3, they close the channel and settle the final balance back on the main blockchain. It's a really clever workaround, but impartially speaking, it's still a compromise. It ultimately relies on that slow base blockchain. And it honestly just hasn't achieved massive, widespread global adoption quite yet.
Which brings us to Section 3, Technical versus Economic Power.
Okay, we are now transitioning from the clean, perfectly theoretical software architecture into the very messy reality of economics, and here is the core conflict. On a purely software level, Bitcoin is perfectly decentralized. The code is public, it's transparent, and it's immutable. Anyone, theoretically at least, can become a miner. But on an economic level, it's a completely different story. The reality is that mining today requires massively expensive hardware and access to incredibly cheap energy. This has predictably led to the creation of huge industrial mining farms, which centralizes the actual creation of new Bitcoin right into the hands of a few extremely well-funded entities. This heavy concentration of wealth leads to what the crypto world famously calls les baleines, or whales. Simply put, these are individual wallets holding massive amounts of Bitcoin. Now, just to be absolutely clear, a whale cannot change the underlying code of the Bitcoin network. But because they hold so much capital, their massive trading movements can heavily influence the market price, create wild volatility, and entirely shift the perceived risk for everyday retail investors in an instant. Now, what's really interesting about this slide is when you define who these whales actually are. The blockchain data is just staggering.
Just 4 specific addresses currently hold between 100,000 and 1 million Bitcoin each. A tiny fraction of wallets controls a massive chunk of the total global supply. But we do have to carefully distinguish between custodial exchanges and true whales. Exchanges like Coinbase hold massive amounts of Bitcoin, sure, but those funds actually belong to their millions of retail users, not the company itself. True whales are entities with direct, autonomous governance over their funds. Think of corporate leaders like Michael Saylor or even the US government. When these entities decide to buy or sell, they can independently cause sudden, massive liquidity shocks in the market.
Let's move to Section 4, Digital Gold and Volatility.
So one of the most popular narratives out there is that Bitcoin's capped supply makes it digital gold, safe, reliable store of value. But traditional stores of value, like physical gold, are prized precisely for their relative stability. Bitcoin, on the other hand, when measured by the Bloomberg Bitcoin Galaxy Index, is pretty much anything but stable. Since 2010, Bitcoin has suffered a 10% maximum drawdown every 6 months, almost like clockwork. And even more severe, it has experienced a brutal 50% drop in about 1/3 of the periods analyzed. We are talking about an asset that can swing up 300% in a year or crash 70% in just a few months. That extreme volatility is fundamentally contrary to what investors traditionally expect from a true store of value.
Furthermore, a true store of value is supposed to be decorrelated from the stock market, meaning when stocks crash, your safe haven holds steady. But let's look at the pandemic market panic for a second. When global fear truly peaked, Bitcoin didn't act as a safe haven at all. While the tech-heavy Nasdaq dropped an intense 30%, Bitcoin plummeted by 65%, more than double the drop of the tech sector. In moments of extreme panic, Bitcoin has historically behaved less like gold and way more like a Nasdaq for the fearless, heavily correlating with high-risk tech assets exactly when you'd want it to protect your downside.
Finally, Section 5, the traditional portfolio.
Okay, we've seen the extreme volatility and the crazy concentration of power. So the crucial point is, what actually happens when we mix this highly unpredictable asset into a boring, traditional, everyday investment strategy? Well, between late 2013 and early 2025, a standard 60-40 portfolio, that's 60% stocks, 40% bonds, without any Bitcoin, returned 5.4% annualized. But if you allocated just a tiny 5% slice to Bitcoin, that annualized return jumped to 8.6%. And here's the kicker. Despite Bitcoin's wild price swings, adding that small 5% position increased the overall volatility of the total portfolio by less than 1%. Historically speaking, a very small calculated exposure actually improved returns significantly without entirely ruining the investor's overall risk profile.
However, we must impartially note a major historical caution here. As they say, past performance is never a guarantee of future results. When financial analysts backtest gold, they have highly reliable data stretching back over 50 years, right to the end of the gold standard in the 1970s. Bitcoin's historical data is incredibly limited by comparison. We literally only have about a decade and a half of data generated during a highly unique era of monetary policy and completely unprecedented technological adoption. We just simply don't have the long-term proof yet to know exactly how it behaves across multiple economic generations.
Which really leaves us with this final overarching tension. Bitcoin was literally born from the ashes of the 2008 financial crisis as a perfectly decentralized, peer-to-peer alternative to the banking system. Yet today, its network is heavily reliant on massive mining farms. Its market is practically steered by corporate and government whales, and its main appeal to traditional investors is capturing the upside of its extreme volatility. So what does this all mean? Is the financial upside of Bitcoin's extreme volatility really worth the deviation from its original perfectly decentralized vision? It's a fascinating paradox, for sure, and one that will undoubtedly shape the future of finance. Thank you so much for joining me for this explainer, and as always, keep questioning the data.